All right. Welcome back to episode 2 of the Bitcoin Macro War Room. Boy, what a week we had this week. We're going to get right into the data because there's a lot to cover this week. All right, let's kick it off with the first thing that we'll go over, which is the Bitcoin Macro and Liquidity Regime Tracker. This is available on TradingView. This is something I put together with all the most important macroeconomic data that drives Bitcoin's price. We got kind of a drop off from the beginning of June. We're now down to a score of about 65, but that's par for the course. We can basically just hang out in this zone for a while until we actually break out for the next leg. And you can kind of see that in Bitcoin's price, right? We've been flirting between 100 and 110 for a while now, but I think that everything here looks positive. We did have a ton of economic data come out this week, which we'll go over next. The only thing I wanted to call out here is the PMI, the ISM Purchasing Managers Index. So we'll actually drop this and we'll expand the rate of change here on the bottom. But you can kind of see here my crappy TA attempt, but we're expanding slowly. The ISM is very important. It basically tracks the heartbeat of the US business cycle. So a rising ISM from low levels suggests expansion and increased risk appetite. So we capture the 3-month delta to try and see the turning points before the crowd sees them. But you can see on this chart, again, this is the monthly, so keep that in mind. We are flirting with 50, basically. Once we get above 50, that's when things really will start to get wild. And the rate of change here is increasing slightly. So we'll wait and see what next month brings. And let's get on to the actual data. What happened this week? What does it mean? We're going to go over it right now. All right, so let's get into the data, right? What happened this week? We had a decent amount of data come out, even though it's July 4th today. So happy Independence Day to all the burgers out there, myself included. And we're going to start off with the ISM Manufacturing PMI. It's still below 50. We got a print of 49, which was above the forecast, which is good. It's turning up. And that's the whole game here. Manufacturing leads the business cycle, as I mentioned. If this creeps back into expansion territory, it's a front run queue for risk assets. Historically, when the ISM bottoms and starts climbing, Bitcoin doesn't just rise, it explodes. ISM is the earliest signal of cyclical momentum. If it turns, if the economy turns and liquidity flows to risk faster than the Fed can basically hold it back. Next piece of data we got here was the JOLTS jobs opening, which came in above the forecast. It's too hot. The job market is still pretending sort of that everything's fine. Tight labor basically means sticky inflation, which is not great for the Fed and how it looks at it. This print kind of throws cold water on the dovish narrative, which means liquidity, in a sense, could stay a little bit suppressed for now. It matters because a strong JOLTS means strong wage pressures, which means, in turn, for the Fed anyway, delayed rate cuts, tighter liquidity conditions. It's a headwind for Bitcoin and risk in general. Again, it's not huge. It's just JOLTS, but it is something to keep in mind. On Wednesday, we had the ADP non-farm employment change. And this print really had a straight up contraction print. I mean, we were expecting 99K and we got minus 33K. So this is a miss. This is one of those data points that kind of cracks the soft landing illusion. We'll see what happens with this one. It could be a one-off print. ADP, in a sense, shows real-time cracks in employment, which is basically the last line of defense before the Fed blinks and starts slashing rates. I think this is actually a bullish thing because Bitcoin benefits from this. It's kind of how liquidity starts to leak back into the picture. Let's keep going. Average hourly earnings. I don't really take too much stock in this, but it did cool a little bit, right? Liquidity will be living another day because of this print. This does matter more than people think, though. If the wages sort of chill, the Fed has a reason to back off the hawkish tone. Bitcoin likes that, right? We have been waiting for Powell to cut. We'll get into the Fedwatch numbers, which have really collapsed in terms of expectations for a rate cut here at the next meeting. But we'll go on to non-farm employment change. So this is non-farm payrolls. It came in a little bit above forecast, just right, kind of not too strong, not too weak, but cracks are forming, right? NFP is holding up, but the miss on ADP and rising unemployment suggests the floor is getting slippery, right? The Fed gets to kind of pretend that everything's fine while liquidity kind of quietly shifts towards reflation. This is a good dynamic for Bitcoin. Next up, we have unemployment rate, which came in lower than the forecast, but it's still, in a sense, it's ticking higher. You can kind of see how it looks over a couple of terms. And it's not panic level, but the trend here matters. Unemployment climbing means that the Fed cut probability should be rising. If this keeps drifting up, it's risk on season for Bitcoin. It's going to front run the inevitable emergency, quote unquote, easing that they may or may not do. So last and certainly not least is the ISM Services PMI. ISM Services, I think, makes up the biggest chunk of the ISM in totality. So we're technically expanding, but it's fragile. You can kind of see the actual prints here. It's still sort of below 55, above 50. It's kind of teetering. But the real takeaway here is that ISM is bottoming across the board, which is a macro turning point, right? This is the kind of cycle turn where Bitcoin breaks out before anyone sort of reads the playbook. Services dominate the US GDP, and this print signals whether the economy can stay afloat or spiral, and above 50 means that risk assets can breathe. So the final sort of alpha summary for the prints this week is that the ISM is rising, wages are softening, labor is slipping a little bit. This is a textbook pre-liquidity phase. If you wait for the Fed to admit it, you're already too late. Bitcoin does not wait for permission. It front runs this system. That's it for the data. Let's take a look at the Fedwatch interest rate cut probabilities. I feel like last week when we looked at this was at 19 or 20% for July 30th. It has now come down to 4.7. Them not cutting is basically a shoo-in at this point. For September, it's 66% that they're going to cut a little bit, and still 30% that they might not cut at all, which to me is crazy, but it's the Fed. They're always going to be behind. They're always going to be slow to react, and they're always going to be too late. Same thing for October, where basically it's a shoo-in that there's going to be a cut. I mean, there's still a 10% chance we stay where we're at, but we can take a look at my favorite chart, which is the probabilities here. Again, this next meeting, 95%, they're not cutting. Then we go down to 66%, 46, 43, and you're still looking at, Q1 of 2026, you're still looking at either basically 100 basis points or 125 basis points, something like that, something in this area. So that's the Fedwatch. Now we'll go into the Bitcoin macro and liquidity forecast. What are the signals saying, right? Same thing. My cycle peak estimate has not changed, Q2 2026. I did make some updates to this spreadsheet. So I've added the first thing that we look at in these videos, which is my trading view indicator. And the way I'm scoring this is that 0.5 for accelerating, meaning it's in an uptrend, and another 0.5 for it being above 50. So for this week, it's scored at a 0.5 with a 75% weight. We're still 98% risk on. All of my sort of institutional research, nothing has changed. Everything is still turbo bullish for the rest of this cycle. And now we'll take a look at these bottom three on-chain indicators, which since last week, not much has changed, but we're going to take a look at sort of how they're progressing. So the IFP is still bearish, which is, again, nuts to me, but this is a really slow moving indicator. It's basically when the IFP goes above the 90-day MA is when this will go bullish. So definitely don't use this for any kind of short-term stuff or trading. It would not be good for that. You'd be way too late, but it's still in a bear market or correction. For the Bitcoin bull bear market cycle indicator, we are still in bullish mode. So that's good. Nothing really has changed there. And then for the last one here, we got the MVRV Z-score bull versus bear. This one is still bullish as well. Nothing else really here on my dashboard has changed. Sharp ratio is still hanging out sort of in no man's land here in the middle. Adjusted Nupal, still good. yellow. Same thing for adjusted MVRV. One thing I did want to bring a note on is long-term holder net change has been super bullish. So generally, long-term holders are the quote-unquote smart money. When they're buying, you generally want to buy. They sort of front run the price moves. So you can see they've been buying like crazy here while retail and short-term holders have been dumping like crazy. And this actually is, if you look on the y-axis, this is one of the biggest net positive changes that we've seen since 2018. Got to take that into account. Don't worry too much about the day-to-day noise. Just look at the long-term run. Where are we heading? I think that's it. I don't think there's much else here to look at. Nothing that was super interesting to me. I think we have a good base here for sort of what's going to be happening next. So as always, I hope you enjoyed this. We'll be back next week. We'll go through another round of seeing sort of where we're at, finding any alpha we can glean. I think I'm going to add a small section here to sort of go through some maybe interesting tweets throughout the week or extra charts that I haven't shared yet. If this helped you at all, hit the subscribe button. I'd appreciate it. And as always, thank you for watching.